Welcome back. I have the privilege of welcoming our second speaker, Shaun Thomas, who is the head of business development at MemberCheck. Shaun will be giving us a talk on how to optimize the use of RegTech as a facilitator for change and to encourage stability amidst a fast evolving regulatory landscape. Shaun Thomas joined MemberCheck in 2018, and during this time, he has collaborated with key stakeholders to establish the organization's strategic goals. And he's worked with clients across the globe to ensure their anti money laundering and counterterrorism financing obligations have been met through MemberCheck's regulatory technology solutions. Without further ado, Shaun, it's over to you.
Awesome. Thank you so much for the warm introduction and opportunity to present at today's RegTech webinar. Just to let you know that it's close to midnight here in Sydney, so unlike my fellow speaker, Dr. Yin, I don't think you'll see me break out into a song anytime soon. However, I do hope that I'll be able to make this presentation an engaging one. So today I'll be talking to you on the topic of how to efficiently use regulatory technology to facilitate change and encourage stability amidst an ever-evolving regulatory landscape. As you can see, this is an overview of what to expect from my presentation today, and I will try and leave 5 to 10 minutes at the end to answer any questions that you might have. So an introduction to myself. My name is Shaun Thomas. I'm the head of business development at MemberCheck, and I've been in my current position since 2018. Since then, I've been able to assist organizations all over the world manage their AML, CTF, and KYC obligations. MemberCheck is an online risk management service that specializes in PEP, sanctions, adverse media, and ID verification. And we have been in business since 2008 and are headquartered in Australia. So our company was born from 3 main principles, which include security, compliance, and technology. And since 2008, we've evolved along with the AML and CTF industry to assist reporting entities all over the world in their compliance with their obligations. So I'll talk more about our MemberCheck service and some of the features and capabilities towards the end of this presentation. So today we're going to take a deep dive into the evolving regulatory landscape and identify how entities are being affected by changes in this landscape. I recently came across an article published by KPMG, which spoke about the regulatory landscape prior to COVID-19 and how at this time the regulatory landscape, or the regulatory agenda rather, for financial services were being reprioritized rather than completely rewritten. So even before COVID-19, regulators highlighted that the persistently low interest rates environment was a key risk, and debate had already begun to reignite whether certain trading practices or fund types contributed towards systemic risk. During the pandemic, we saw that financial services were granted certain concessions, including the use of capital buffers, easing of reporting and disclosure requirements, changes to market position limits, and delays to implementations or consultation deadlines. With the concessions being granted, the aim was to encourage recovery and growth and to ensure that this happened in a controlled way in the interest of financial stability and investment protection. So moving forward, what will the new reality look like? And what are some of the evolving regulations that entities would be subjected to? Well, all parties will need to embrace the evolving new reality, which includes an increasingly digital society, changes to working practices, demands for sustainable finance, and greater awareness of global interconnectedness. Regulators will demand that firms take greater care of customers. The strong governance and good conduct have long been regulatory imperatives, but as we look ahead to firms' duty of care, they will be reshaped and brought to the forefront. In addition, a focus on operation resilience will move to the top of the agenda, and part of that will include the business continuity planning, IT infrastructure, including a heavy focus on cybersecurity, AML policies and processes, and the protection of clients' assets and data. Regulators will require firms to show that they have thought about the lessons that they've learned through the pandemic and how they are actioning them accordingly. It is becoming more apparent that regulators are motivating reporting entities to use technology that make it investing simpler and cheaper for investors, whilst also protecting the investment ecosystem from technology that both facilitates crime and can lead to poor investment choices. An organization's technology and digital transformations will therefore be kept under tight scrutiny. The firm's duty of care will also be re-articulated. Regulators are requiring firms to always put clients' interests before their own and are asking questions about stewardship and short-termism. Increasingly, regulators are likely to threaten enforcement action if firms' culture and conduct do not meet regulators' and clients' expectations. So the pandemic has added to the momentum, and regulatory initiatives have spread around the globe, with the growing focus on social issues, including diversity, as well as environmental ones. So with the above being said, what do organizations actually need to consider when moving forward? They should consider re-evaluating the procedures and controls to ensure compliance and operation resilience, standards including BCP, IT, cybersecurity, AML, and client asset and data protection. They should also assess risks deemed by regulators as systemic. We've seen regulators these days focusing on liquidity management of open-ended funds, as well as the use of leverage. Organizations should start thinking about what they should do, not whether they can do it. Organizations also should need to adjust their regulations regarding disclosures on commissions, payments for investment research, and performance fees as rules evolve. Now, this is much easier said than done. And for an organization to manually implement and monitor these changes would take a substantial amount of time and would be an overall insufficient process. As such, entities need to look at solutions offered by Rectechs, which will assist them in adapting to regulatory changes in a more streamlined manner and will encourage stability and compliance within that organization. So as mentioned in Dr. Yin's presentation, RegTech is short for regulatory technology, and is an application of technologies to improve the way businesses manage regulation and compliance. RegTech brings with it productivity, efficiency, lowering of costs, and increased safety and confidence for a company. So why is RegTech critical for regulated entities? The cost of compliance has increased, and a study by the RegTech Association has shown that in 2021 alone, organizations have spent $287 billion on their compliance programs. In addition, regulatory fines for non-compliance resulted in $14.2 billion worth of fines. The use of RegTech not only gives greater transparency for executive teams to identify shortcomings and areas of risk, but also help in delivering superior outcomes for customers and shareholders, and helps build stronger and more sustainable businesses. So this slide runs through a taxonomy of RegTech capabilities, and you can see the risks that RegTech can help address, as well as the functional role they service within an organization. As you can see, the number of risks that RegTech can help address is definitely quite extensive. With the above being said, I would like to share with you 2 case studies on how organizations have failed to efficiently adapt to changes in AML regulation, as well as how these organizations have failed to use RegTech solutions to manage particular areas of risk. So I'll start with the more recent case study of CLSAP, formerly known as KVB Kunlun, which is a New Zealand derivatives trading firm and subsidiary of a Hong Kong company. CLSAP was fined $770,000 for breaking AML laws on transactions amounting to $50 million. The company admitted it was out of line with the AML and CTF Act and failed to conduct enhanced customer due diligence on numerous suspicious transactions, conduct customer due diligence in relation to several high net worth customers, terminate existing business relations when customer due diligence could not be completed. They failed to report suspicious transactions and activity on 9 separate occasions, as well as failed to keep records in accordance with the law. Now, FATF recommendations are clear, and whilst they are updated from time to time, organizations need to ensure that the appropriate risk assessments and reviews of AML programs are done on a yearly basis to ensure compliance with the recommendations. Based on these assessments, policies and processes need to govern the organization's entire workflow, from onboarding a customer to terminating those customer relationships. In the case of CLSAP, the FMA's head of enforcement, Justice Edward, stated that the company's failure to obtain any evidence of source of wealth or funds for some of the transactions where enhanced customer due diligence was required is particularly concerning. The business was warned by the FMA about its substandard AML and CTF program. And in 2014, so that was in 2014, and despite slight improvements, the FMA identified further issues again in 2018. In one case, CLSAP's executive directors interfered directly with compliance protocols by suspending information collected on source of wealth and funds, and the director personally vouched for the customer's source of wealth. In another case, when one customer refused to provide the appropriate information sought, the company was willing to accept inadequate information, including objectively suspicious information, in order to retain business. Ms. Edward also stated that the ruling sent a strong message that there are serious consequences for firms which choose to prioritize profits over following AML CTF requirements. It is crucial that all firms take their compliance obligations seriously, ensuring that they not only have the right programs in place, but that the programs are followed by staff. This reminds me of something that I read earlier today, which is if you think the cost of compliance is high, think about the cost of non-compliance. Since the ruling, the owners of the company have made significant wide-reaching changes to completely transform the company and ensure high standards of ongoing compliance. A new board and management team have been appointed, and the company has invested in a higher standard of ongoing compliance, and an independent review of the compliance program was undertaken. So relating this back to the topic for today, it is important that reporting entities understand their compliance obligations in line with changes to the regulatory landscape. COVID-19 has resulted in a fast-track transition towards a more digitized economy, and as such, it is expected that regulatory bodies will start imposing and enforcing new obligations and standards for companies to comply with. By optimizing an organization's use of regulatory technology to conduct both due diligence and transaction monitoring, and enforcing the correct procedures that staff and directors should follow when dealing with suspicious transactions, I believe CLSAP would have been able to avoid being fined, as well as avoid the reputational damage that was caused as a result of the ruling. So the second case study is on a top 4 bank in Australia called Westpac. In September of 2020, Westpac agreed to pay a penalty of $1.3 billion, which, by the way, is one of the largest civil penalties in Australia's history, and came about because of breaches of the AML-CTF Act. Westpac admitted that it failed to properly report to the Australian regulators over 19.5 million international fund transfers, amounting to over $11 billion. They failed to provide information about the source of funds to other banks in the transfer chain, which these institutions needed in order to manage their own money laundering and terrorism financing concerns. They also failed to keep records of the origin of some of the international fund transfers, as well as failed to appropriately assess and monitor the risks associated with the movement of money into and out of Australia. And finally, Westpac did not carry out any appropriate CDD in relation to suspicious transactions associated with possible child exploitation. So like the message shared by the FMA's head of enforcement, Austrac CEO Nicole Rose said that the penalty sends a strong message to the industry that Austrac will take action to ensure that the Australian financial system remains strong so that it cannot be exploited by criminals. Westpac's failure to implement effective transaction monitoring programs and its failure to submit international fund transfers reports to Austrac and apply EDD in relation to those suspicious transactions meant that Austrac and law enforcement were missing critical intelligence to support police investigations. Like CLSAP, the situation which Westpac was faced with could have been avoided by using RegTech to introduce more appropriate assurance and oversight procedures, which would have helped identify ongoing reporting failures. Since settlement, Westpac has worked collaboratively with Austrac and other independent RegTech providers to implement a more effective and robust transaction monitoring solution, as well as better CDD practices. So whilst the regulatory landscape continues to shift and evolve, we have also seen a shift in the RegTech landscape, whereby RegTech providers are moving away from being able to only service a few aspects of a business's risks, and instead now wish to offer a complete service that offers end-to-end fraud, risk, and compliance solution. This shift offers reporting entities with a service that is more holistic in nature, which not only benefits the organization from an operational perspective, but it also allows for a higher level of interconnectedness amongst internal processes and leads to stronger levels of compliance and better efficiencies. So as mentioned in the previously discussed case studies, it is common for silos to exist within an organization's compliance processes. And without having a consolidated overview of the entire process, executive teams can struggle and can miss blaringly obvious signs of risks and struggle to make strategic decisions which are in the best interest of that organization. So to talk a bit more about MemberCheck's service offering, our company offers a whole suite of AML, CTF, and KYC solutions, including but not limited to global PEP and sanction screening, adverse media, ID verification, which includes biometrics and facial recognition, and business verifications. So these services can be accessed through our user interface or via API, should you wish to streamline your onboarding process. Just a few stats. Since our inception, we've had over 60 million checks performed through MemberCheck and have over 10,000 customers worldwide. And we cover over 195 countries. Our database is also updated on a daily basis to ensure that it is as accurate and as reliable as it should be. Here are some of the clients that use our service, as well as the typical industries that we serve. As mentioned, MemberCheck is our risk and compliance solution. However, we do have a sister company called G Payments, which offers fraud management solutions. A quick background on G Payments: the company was created in 1999 and focused on providing a robust payment and authentication solutions for online transactions. They provide a complete range of integrated authentication products based on the 3D Secure protocol to financial institution services, service providers, merchants, and cardholders. Relating this back to the topic of today, G Payments has also seen a shift in the regulatory landscape. Under the original 3D Secure protocol, which is 3DS1, cardholders were challenged every time via SMS as part of the payment process. However, advances in risk-based authentication technologies with 3DS2 allow the issuer to collect far more data to assess the risk associated with transaction, which often eliminates the need to challenge the cardholder. So doing this frictionlessly behind the scenes with 3DS2 improves the customer experience, not just reducing fraud, but also increasing successful transaction rates and reducing incidents such as card abandonment. The regulatory landscape is evolving, and merchants relying on the original 3D Secure protocol must migrate to 3DS2 by October of 2022. So to summarize, throughout this presentation, I've discussed the evolving regulatory landscape that businesses are subjected to. By reviewing multiple case studies, we have identified how complacency and a lack of sophisticated regulatory technology has led to large fines and reputational damage, which in most cases is irrevocable. Finally, I've discussed how there is a paradigm shift happening in the RegTech space, where a consolidation of fraud, risk, and compliance solutions are key in driving efficiency and encouraging stability amidst an ever-evolving regulatory landscape. I'd like to thank you for your attention today, as well as thank our hosts for the opportunity to share my thoughts with you today. I've left my contact information on this slide. Please feel free to get in touch with me to further discuss any questions that you might have. Thank you. I think you're on mute.
Sorry.
Yep,
No
problem.
While I'm at it, one of our audience members has commented to ask whether it would be possible for you to share your slides.
Absolutely, no problem. If I can send that to you maybe, and then is that okay?
Yes, that's perfect. We'll get your contact details. Thank you
Sure.
so much. So now we will be heading to a quick break, and we'll join you just after the break shortly.